Big opportunities in life have to be seized. We don't do very many things, but when we get the chance to do something that's right and big, we've got to do it. And even to do it in a small scale is just as big a mistake almost as not doing it at all. I mean, you've really got to grab them when they come.
Well, the answer is I do believe in dividends in a great many situations, including many of the ones, companies in which we own stock. The test about whether to pay dividends is whether you can continue to create more than $1 of value for every dollar you retain.
Welcome to Mensis Money Mentor channel. Today, we're diving into an exciting topic: how to retire early using dividend stocks. If you're new to investing or just curious about how dividends work, don't worry, we're starting from scratch. By the end of this video, you'll understand the basics of dividend stocks, how they work, and how they can help you achieve financial freedom. Let's get started. What are dividends and dividend stocks? When you buy a stock, you're essentially buying a small piece of a company. This makes you a shareholder, and as a shareholder, you're entitled to a share of the company's profits. Some companies choose to reward their shareholders by paying them part of these profits in cash. This cash payout is called a dividend. Not all companies pay dividends. Those that do are referred to as dividend stocks. These companies are typically stable and mature businesses. Think big names like Coca-Cola, Johnson & Johnson, or Procter & Gamble. How do dividends work? Let's break it down with a simple example. Imagine a company has 1 million shares of stock and decides to distribute $1 million in dividends. If you own 1 share, you'll receive $1 as your dividend payout. If you own 10 shares, you'll receive $10 and so on. These dividends are usually deposited directly into your brokerage account as cash, which you can withdraw, reinvest, or use however you like. Key dates to remember: declaration date. When the company announces it will pay a dividend, ex-dividend date. You must own the stock before this date to qualify for the dividend. Payment date, the day the dividend cash hits your account.
There are many businesses. Take See's Candy, which we own. See's Candy has paid everything virtually out to us that they've earned because they do not have the ability within See's Candy to use large sums, which they earn, intelligently in their business. So it would be an enormous mistake for See's Candy to retain money. So they distributed Berkshire, and we hope that we move that around in some other area where that dollar becomes worth $1.10 or $1.20 in terms of present value terms. If we do that, the shareholder, whether they're taxable or whether they're not taxable, whether they're a foundation or whether they're living on income even, they are better off if we retain the money, because if they were going to get $1 in dividends and it became worth $1.10 or $1.20 in market value immediately on a present value basis, they're better off selling a small percentage of their stock and realizing the required amount that way, and they will have more money when they get all through doing that than if we paid it in dividends. But if the time comes, and it will come someday, if the time comes when we don't think we can use the money effectively to create more than $1 of market value per dollar retained, then it should be paid out. And like I say, we do that individually within Berkshire, but because we have this ability to redistribute money in a tax efficient way within the company, we probably had more reason to retain all of our earnings. If See's Candy were a standalone company, we would simply pay out a lot of the earnings, practically all of the earnings and dividends, just like we do now, except it goes to Berkshire. We like the companies in which we have investments to pay to us the money they can't use efficiently in their own business. In some cases, that's 100% of what they earn. In some cases, it's 0% of the earn. We own some stocks that don't pay any dividends.
Why are dividend stocks powerful for early retirement? Well, dividend stocks offer 2 major benefits. First, there's passive income. Over time, dividends can provide a steady income stream without the need to sell your investments. Second, there's compound growth. If you reinvest your dividends to buy more shares, your investment grows faster, thanks to the power of compounding. For example, let's say you invest $10,000 in a stock with a 4% annual dividend yield. That's $400 a year in dividends. If you reinvest those dividends and the stock continues to grow, your income and portfolio will expand year after year without adding extra money. Steps to retire early with dividend stocks. First, start early. The sooner you invest, the more time you give your dividends to grow and compound. Second, focus on quality stocks. Look for companies with a strong history of paying and increasing dividends. Third, diversify. Don't rely on just one stock. Spread your investments across industries like utilities, healthcare, and consumer goods. Fourth, reinvest dividends. Use a dividend reinvestment plan or DRIP to automatically buy more shares with your payouts. Finally, set a goal. Calculate how much passive income you'll need to cover your expenses in retirement. Common mistakes to avoid: chasing high yields. A stock with a 20% yield might seem tempting, but it often signals trouble. Stick with sustainable dividend payouts, ignoring taxes. Dividends are taxable income, so plan for the tax implications. Lack of research. Not all dividend stocks are created equal. Always analyze a company's financial health before investing.
Hi, my name is Charlie Rice, and I'm a stockholder from St. Louis, Missouri. Appreciate hearing your comments on publicly held companies using their cash for dividends versus stock buybacks.
Well, the equation is pretty simple, but the practice doesn't necessarily follow logic. It's obviously, as long as you're telling the truth to your shareholders about what's going on so that you aren't manipulating the stock downward or something, when a stock can be bought well below its business value, that probably is the best use of cash. It's something the Washington Post did on a huge scale back in the 1970s. Teledyne may have bought 90% or something or close to it of their stock back. And that was the reason a very significant percentage of companies bought stock back in the past, because they actually thought it was selling for less than it was worth. Like I say, that can be abused if you do various things to bury your stock in one way or another, but that wasn't the usual case. Stock repurchases were relatively unpopular in those days. They've become quite popular now, and to the extent that I've been around a good number of them and been able to pick up on what I thought was the underlying rationale, if not the professed rationale, I think it's often done for people that are hoping that it causes their stock price not to go down, and often done at prices that don't really make a lot of sense for continuing shareholders. If we wanted to return a bunch of cash to shareholders, we would, if our stock was undervalued, we would go to the shareholders and say, we think it's cheap, and we think that this cash can be better used by you than by us, and we will therefore be repurchasing at what we think is a discount intrinsic value, and the people that remain will be better off, and the people that get out will get out at a little bit better price than they would otherwise. In terms of dividends, you get into an expectational situation. And for most companies that pay a cash dividend, it doesn't make sense to bounce around the dividend from year to year, although private companies frequently do that. And we do it ourselves with our subsidiaries. Some subsidiary can pay us a lot of money one year and not so much money the next year. But with public companies, a lot of people do buy stocks to obtain dividends, and they hope for regularity, and there's a signaling aspect to it and everything. So I would say that once you establish a dividend policy with a public company, you should think a long time before you change that policy in a material way. But I think the best use of cash, if you don't have a good use for it in the business, if the stock is underpriced, is to repurchase it, and if it's overpriced, you got no business buying in a single share. But a lot of companies do it. Charlie?
Yeah, dividends are a very interesting subject. If you count the unnecessary stock trading and the cost of investment advice and the cost of making a lot of errors in the trading costs in and out, I don't think it would be too extreme to say that now the total amount that's paid out in dividends is roughly equal to the amount that is wasted in all this trading and investment advice. So that the net dividends that come to the shareholders are approximately zero. This is a very peculiar way to run a republic, and very few people comment about it.
Yeah, actually I did in an article some time ago in Fortune. The frictional costs to American shareholders in sort of changing shares for all American business as a whole, those frictional costs are probably not much different than the entire amount paid out by American corporations. So, but getting to the individual corporation level, a company that expects to regularly earn more than it can profitably employ in its business should be paying out dividends. Take a subsidiary of ours like See's Candy. We would love to expand See's Candy to double or triple its present size, but it doesn't work. We've tried it a lot of different ways. So it should be paying out its earnings. If it was a public company, and it was at one time, you could argue that something approaching a 100% payout would make sense there. But most management's worrying about earnings falling off at some time in the future would rather establish a lower level and therefore ensure regularity of dividends by going with a conservative level. It's obviously something we think about at Berkshire when we have $30-odd billion around. If we can't figure out a way to employ that over time, it's a mistake to keep it in corporate form. But we have this expectation, and I think it's a reasonable expectation, that we get to put it to work. If we ever came to the different conclusion, if we thought our stock was significantly undervalued, we'd probably figure in terms of dispersing it through repurchases, particularly where now dividends and capital gains are neutral for individuals. If our stock was not underpriced and we fell, we would probably do something by a dividend. It's not going to happen soon, however.
Can you really retire early? Absolutely. Many investors achieve financial independence by carefully building a portfolio of dividend stocks. The key is consistency, patience, and reinvestment. Over time, your dividend income can replace your 9-to-5 paycheck, giving you the freedom to retire on your terms. Get started today. If you're ready to start your journey with dividend stocks, check out the resources linked below. You'll find step-by-step guides, beginner-friendly tutorials, and exclusive sign-up bonuses for brokerage accounts. Don't forget to like this video, subscribe to the channel, and turn on notifications so you never miss an update. Together, let's make early retirement a reality. Thanks for watching, and we'll see you in the next video.